Hey everybody, how are you doing? Welcome to another edition of the Biotech Capital Compass. This edition is another one of the biotech tape checks that we tend to do. Um, with all the ructions going on in the broader markets and the geopolitical stress that we're under, felt it was kind of important to just get something out quickly this weekend, looking at how biotech has been doing. Um, I am, if you're trying to guess, in Northern California, in San Jose, at the beautiful Hayes Mansion at my niece's wedding. Her wedding was actually yesterday, but it's the fourth of 5 days of Indian style celebrations. It's been fantastic, but also a little tiring, but also fantastically invigorating. So let's get to it. We call this the Biotech Tape Check, a more selective market under geopolitical stress. We spend a lot of time in biotech talking about data, catalysts, FDA decisions, and capital raises. Fair enough. But sometimes it helps to step back and ask a much simpler question. What is the tape actually saying? That's what the biotech tape check is all about. Because here is the backdrop. Conflict involving Iran and the broader Middle East has now been hanging over the market for more than a month. In a setup like that, you might expect biotech to simply get tossed aside as high risk beta. But that is not really what the tape seems to be saying. Start with, let's say, comparative performance. Biotech has not looked like a sector in full retreat. It has bent, it has rotated, it has gotten selective, but it's not really broadly broken. And that matters. XBI, which usually gives a better feel for the broader and more speculative biotech complex, has held together better than one might expect in a macro tape like this. IBB has offered the steadier large cap lens. BBC has helped show what the market is still willing to carry, clinical stage risk. And we have like the actual definitions of these ETFs in the newsletter if you just go to the bottom of the acronym summary. Put together, the picture looks less like blanket fear and more like differentiation. Then there's the technical setup. On the longer dated charts, XBI still appears to be in an intact uptrend. That does not mean that the move has been clean. It has not. The shorter term tape has been choppier, more reversal prone, and more sensitive to headlines. That's to be expected. You know, biotech is very volatile. So it has been volatile, but the broader structure has not collapsed. That's the key here. In year to date 2026 trading, XBI spent much of the period chopping around before rebounding into late March and early April. That is not the same thing as a decisive breakout, but it does suggest the sector still has some technical footing. So again, you know, just on the technical trends don't look great, but they don't look bad either. Now let's look at volatility. That's been something we've been focusing on. One of the more useful signals here is implied volatility in the XBI. Bloomberg defines it as the market's expected future volatility embedded in options pricing currently. In plain English, it is one way to measure how nervous the market still is, even when price itself looks fairly calm. Over the past year, implied volatility moved in bursts rather than in one constant wave. This is for biotech. It tended to spike when price action weakened or reversed, and ease when the tape became more orderly. Recently, volatility has cooled from sharper spikes. That is constructive, but it has not cooled enough to say that the market is fully relaxed. Neither is biotech, right? That's kind of important. Then you look underneath the index, and this is where things get even more biotech. The NBI leadership and laggard tables show huge dispersion. Some names are ripping higher, others are getting crushed. So even when the index itself looks fairly stable, the single stock experience can be brutal. That is classic SMID cap biotech. SMID stands for small mid cap biotech. It is still a stock picker's tape. That's what we love about biotech. It is still a stock picker's tape, meaning you can make alpha here, you know, on top of smart beta if you're looking at the larger cap names. The market is rewarding certain stories aggressively and punishing others just as aggressively. And that same theme shows up in liquidity. On the deal side, the first quarter of 2026 was not especially broad by count, but volume held up better than one might expect. That tells me capital has not left the building. It is still there. It is just being deployed more selectively. Same story in equity issuance. The window is open, but it's not wide open. Companies can still raise money, but it's not the kind of market where weak setups get a free pass. And again, we have this analysis in the newsletter. You can read down to it. If looking at my face and looking at this beautiful surroundings here in South San Jose is either boring you or getting you upset, look at the data. So what is the big takeaway here? Biotech currently looks less like a market driven by indiscriminate optimism or outright panic, and more like one being underwritten with a high bar for belief. The sector is functioning, the tape is holding together, but it is selective, discerning, and still very capable of punishing weak positioning. That may be the most important message of all. The indices can look resilient, but beneath the surface, this is still biotech. The science matters, the setup matters, the balance sheet matters, and increasingly so does whether the market believes your story deserves capital in a world that has become a lot less forgiving. So that's really where biotech is right now. I hope this is useful. I hope you're having a good weekend wherever you are. And I really do hope the weeks ahead of us get better than what they have been over the last few. I think they should, but let's keep our fingers crossed. But let's keep doing the work. Take care and talk soon.